January 5th, 2026, BlackRock's Bitcoin ETF records a $372.5 million inflow, its largest single day so far this year. But Bitcoin's price goes down. And February 5th, $10 billion in trading volume, but price crashes 13%. And February 10th, another $26.5 million in new flows. But Bitcoin still $67,000, down 47% from the $126,000 all-time high in early October. So if you're wondering why massive institutional buying isn't moving the needle, why it's not moving the price, you're not alone. I've been wondering that too. And that's why today I did a deep dive for you and I'm breaking down the actual mechanics of how ETFs work and why the supply and demand logic fails here, and whether this is manipulation or just market structure. So let's get into it. Okay, so here's what makes no sense. Mid-January, Bitcoin and Ethereum's ETFs had their best week since October with nearly $2 billion in combined inflows. By early February, though, Bitcoin's at $67,000. And BlackRock's IBIT ETF now holds approximately 765,000 Bitcoin as of February 10th. That's $54 billion in assets. That's roughly 3.5% to 3.7% of Bitcoin's fixed 21 million supply. And we know that IBIT is the largest spot Bitcoin ETF and one of the largest known Bitcoin holders globally outside of Satoshi's stash. So we've seen massive institutional accumulation, record volumes, and price still nevertheless cutting in half. Economics 101 says bigger buyer, limited supply, price goes up, right? So why isn't this happening? Now, most people like myself have jumped or do jump to conclusions and say, this is manipulation. They're buying off exchange. It's rigged. But here's what's actually going on, and it's more interesting than conspiracy. Apparently, institutional market structure operates on completely different mechanics than retail spot trading, and almost nobody's explaining how this infrastructure actually operates. So I thought I would give it a go and show you. So first off, it's important to understand there are 4 key players in ETF infrastructure. We call these authorized participants. These are major broker-dealers like JP Morgan, Jane Street, Citadel, and they're the only entities, that can create or redeem ETF shares directly with BlackRock. You and I can't do this. We just buy shares, if we do, on the stock exchange. And then there is the ETF sponsor. This is like BlackRock, for instance, managing the trust. And then there is the custodian. And for BlackRock's case, for their IBIT ETF, Coinbase is their primary, with Anchorage Digital as their backup custodian. And they hold the actual Bitcoin. And then lastly, we have the market makers. They provide liquidity on exchanges. And this is how it works. When an authorized participant, those I just mentioned, creates new ETF shares, they assemble Bitcoin, deliver it to BlackRock, and receive 40,000 ETF shares in return, representing roughly 22 to 23 Bitcoin worth over $1.5 million. And then they sell those shares to retail or their clients. And redemption is the reverse, of course. It's when the authorized participant, we'll call them APs, buys ETF shares and then returns them to BlackRock, which in turn makes them receive Bitcoin. And then they get to liquidate this. The critical point here is that price impact depends entirely on where and how that Bitcoin gets sourced or sold. And this is where institutional structure diverges from retail, allegedly, which actually a lot of this happens in retail as well. So it goes like this. When APs, authorized participants, need Bitcoin for creation, they typically don't market buy on Coinbase. They call OTC desks because they're private, negotiated trades. There's no public order book, no visible price discovery. An example of this to bring it to life would be if an authorized participant, for instance, needs 5,000 Bitcoin and they call Cumberland or Galaxy Digital and they say, I need 5,000 Bitcoin at $68,000. The OTC desk has inventory or sources it privately from miners, institutions, or other long-term holders. The transaction then settles off an exchange, and it doesn't hit Coinbase, and therefore doesn't move the public price. Why OTC? Well, there are three reasons. First, there's slippage avoidance. Buying 5,000 on an exchange moves the market against you. Two, there's speed, instant execution versus dripping orders for days. And thirdly, privacy. Institutions don't want the market front running their positions, of course. So when you see BlackRock bought $370 million worth of Bitcoin, what likely happened is the AP sourced that Bitcoin via OTC days or weeks earlier. The ETF creation filing is just the final administrative settlement. The actual market moving transaction either already happened off exchange or bypassed public markets entirely. And market makers, of course, add another layer. They pre-buy Bitcoin, simultaneously short futures to hedge, then unwind when creations happen. Net market impact is essentially neutral, right? Because buying happened during hedge setup. Selling happens on unwind. And now here's the game changer. When Bitcoin ETFs launched in January 2024, the SEC required cash-only creations, and that's increased the likelihood of market-facing spot buying during settlement. But by July 30th of last year, 2025, the SEC approved in-kind creations under Chairman Paul Atkins. Now, APs deliver actual Bitcoin directly to BlackRock. No cash, no requirements for the sponsor to buy in the market, meaning the Bitcoin backing new ETF shares was often already purchased weeks earlier and frequently via OTC. So the price impact either already occurred off exchange or didn't occur at all. And this structural change is why you see massive inflows with zero price movement. The mechanics no longer forces visible on-exchange buying. And here's where it gets critical. There's a built-in asymmetry between creations and redemptions, and it creates downward bias. Creations, we know, are when APs typically source via OTC with prearranged hedges, smooth, distributed, and invisible. And redemptions, we know, are completely different. APs buy ETF shares, returns them to BlackRock, receives Bitcoin, and needs to liquidate quickly, because they want and need immediate liquidity. So they often hit public markets. And this is where we feel it, because they sell on Coinbase, Kraken, and Binance. And that selling does show up in order books, whereas their acquisition didn't. And this does end up moving the price down. So the result is one where inflows that are often sourced off exchanges, once again, to make this super clear, end up having a minimal visible impact up, whereas outflows more likely hit exchanges, which creates direct pressure down. But now, let us take a look at the data, because from November 2025 through late January 2026, just last month, roughly $5 to $6 billion in net outflows is what we saw. Morningstar Direct reports $5.7 billion, which is the longest redemption streak since launch. And on January 29th, $818 million went out in outflows. And just very recently, on February 4th, we saw $545 million exit in outflows. Multiple sessions over $500 million, many led by BlackRock's IBIT. That Bitcoin got liquidated. It went to APs and likely hit spot markets. And here is why it matters so much. Bitcoin's market depth collapsed. According to Kaiko analyst Thomas Probst, I hope I said his name right, Bitcoin's 1% market depth was over $8 million in 2025. And this year, February, approximately only 5 million. So the translation is this: the same 500 million redemption that moved Bitcoin 5% at an 8 million depth now moves it 10 to 15% at a $5 million depth. The market's thinner and more fragile, so the redemptions hit harder. Even Wintermute's strategist Jasper Demer described recent selling as sell at any price working orders, not strategic distribution, panic liquidation. And that's the environment we're in. But let us address this manipulation question more directly. Is this price suppression? Can these mechanisms that I described be exploited? Well, the answer is yes. But is that what is happening? Probably not how you think. A quick rundown of theoretical vectors are as following. One would be spoofing. That is when fake buy orders get submitted to pump the price, then they're canceled, and then they just sell into the rally. The reality of that, well, is explicitly illegal. The CFTC prosecutes this. So it's highly unlikely at an institutional scale. The next possible concern would be in wash trading, right? This is when entities trade back and forth to fake volume. This has been a huge problem in crypto. But the reality, if we look into it, is that Bitcoin's on-chain and transparent. So it's hard to do this at the scale needed in order to suppress Bitcoin's price on a system-wide level. The next concern that has been flagged in crypto is this whole OTC collision. Is this whole OTC collision topic or concern? And this, we know, is when multiple desks, OTC desks, coordinate to source quietly and then dump aggressively. Now, the reality is that this requires sustained collision across direct competitors, which is also unlikely because they're competitors. And then next, there is the whole timing arbitrage problem. And this is when APs, or authorized participants, source OTC, right, over the desk or over the counter, redeeming on an exchange to maximize downward pressure. When in reality, although this is not illegal, it's arbitrage. If the structure creates this advantage, participants do exploit it. And then there's the futures coordination. This is where if one were to short futures, this ends up triggering a cascade, a price cascade via ETF redemptions. And the reality is this is legal hedging activity, and it's nearly impossible to prove coordination. So my assessment on whether this is pure manipulation via coordinated spoofing, systematic wash trading is highly unlikely because there are too many participants with under too much oversight talking about a system that is highly transparent. But structural asymmetries, creating downward bias, absolutely. The system enables quiet OTC acquisition for creations. It enables public liquidation from redemptions. And collapsed market depth amplifies the selling, with the APs optimizing execution by exploiting inefficiencies. So this isn't conspiracy, this is institutional market microstructure. And if we combine asymmetry plus deteriorating liquidity, plus the $5 to $6 billion in outflows and the 47% drawdown, that's exactly what we're seeing. Large inflows don't move price up. Moderate outflows crash it down. It's mechanical, structural, not fraud, just how infrastructure operates under stress, the current infrastructure anyway. So this is what this means for us. First off, we know that ETF holders are not necessarily Bitcoin maxis. They're not necessarily diehard believers. They're just tactical allocators. And Jim Bianco calculated average ETF cost basis since January 2024, approximately $90,146. And Bitcoin's at $67,000, with average investors underwater by roughly 25%. And these aren't strategy, they're just financial advisors allocating 1% to 2% of traditional portfolios. They're traders sitting on 25% drawdowns. So when we have a setup, a dynamic, when the macro is deteriorating or is highly shaken, where the Fed is holding rates and inflation is elevated, making equities sell off, well, these people liquidate because they're just professional allocators managing risk and they have stop losses. Secondly, it's important to understand the mechanism and how the system works. So it helps clarifying what's going on and so that we don't fall into conspiracy unnecessarily. So when BlackRock reports $370 million in new acquisitions and the price doesn't move, just understand you're not being gaslit. You're simply observing the way the institutional infrastructure system around ETFs works. And honestly, it works quite similarly to how things work in the retail world. And just remember that Bitcoin, and these large purchases were likely already sourced via OTC desks weeks earlier. That said, creation filing is administrative. Price-moving transaction either happened off exchange or bypassed public markets. And we do see dumps or corrections when the shares get redeemed. This is when Bitcoin often does hit exchanges, creating measurable downward pressure. So it's not manipulation, it's just asymmetric microstructure in a low liquidity game or environment as we're in right now. And then thirdly, and perhaps the most important, is that institutions, as I've been saying in my past videos, still don't understand what they own. So this is our opportunity. Right now, we know that institutions are still learning. They're still treating Bitcoin like a high beta tech stock, trading it on Fed policy, macro sentiment. It's still highly, for them, NASDAQ correlated, and for us because we feel the effects. So this, once again, creates our structural opportunity, not in trading ETF flow headlines, and definitely not in chasing short-term action, but in understanding we're early in institutional adoption. In-kind creations were approved just 7 months ago. And remember, major banks just started custody last year. And the Clarity Act is still ongoing. They're still working out their negotiation. It's still stalled in the Senate. But we know they have a deadline. They have to come to some form of consensus by the end of the month. So remember, we're still in the building the rails phase. When the infrastructure fully matures and the regulatory framework solidifies, institutions will stop treating Bitcoin like software and will start treating it like digital gold with fixed supply. So yes, Bitcoin's price might still be subject to the OTC volume available to these ETFs and APs for purchase. And when they sell, as they continue to learn Bitcoin's value, we'll still feel that huge downward pressure once they sell or dump into the market. But as they continue to learn, I believe, this is personal to me, I believe that these drawdowns will be less and less because they're going to continue to be educated. So as we wrap things up today, the bottom line is this. When BlackRock reports $370 million and price doesn't move, you're simply witnessing institutional settlement mechanics, not manipulation. And you're getting a glimpse, honestly, of how things work in the crypto retail market. Because as it pertains to ETFs anyway, when these big purchases are being announced from different ETF authorized participants, the Bitcoin they're buying was already sourced over the counter before the filing, before the announcement happened, just sitting there in Coinbase's custody. Remember, creation is administrative. That's why you see no price impact, because the price impact either happened off exchange or bypassed public markets entirely. However, when we see huge drawdowns because of these huge ETF outflows, we're seeing redemption in real time. And if the market has been recently shaken and Bitcoin, that is being sold, hits order books in thin volume liquidity conditions, that's when we see the huge corrections. So once again, this isn't conspiracy. This is just the way the market incentive model is designed. This is traditional finance infrastructure interfacing with a 24/7 global digital asset. So it's the two worlds colliding. And understanding the mechanisms I described today will stop you from being confused and feeling like a victim in any case from these big new whales in our playground. Remember, education is always the key, which is why I make you these videos to help you understand what's going on. So that's a wrap for today's video. I hope you gained value. I love you guys so much. Let me know if you had any questions or if anything was unclear, and I would be so happy to address them in an upcoming video. Take care, guys.